Good afternoon and welcome to AIADA's Auto Talk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone who is registered for today's program will be receiving a copy by later this week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Now, please join me in welcoming back our good friend, Cox Senior Economist, Charlie Chesbrough. Charlie, I know you have a lot and more than a lot to get to today, so I'm going to let you take it away.
All right. Well, thank you so much. And thank you for having me here again today. We're going to give you guys the automotive outlook and what we're seeing here as we finish up the year of 2023. And I titled my presentation, Recovery to Continue, because that's basically what our view is as we go into this next year, is that we remain cautiously optimistic that even though there's a tremendous amount of headwinds out there, that vehicle sales are still going to get progressively better, just a little bit this year. We're not expecting any kind of a bang up year, but we do see both the new and the used vehicle market just ticking up a little bit, essentially flat, but a hair on the upside, which I think is a pretty good spot to be in given all of the headwinds that we're dealing with. But it does feel like that the situation out there in the economy is maybe improving. And that's what I want to start off talking about with today. We're going to go through the economic and automotive outlook and talk a bit about the possible recession or not. There's been a lot of concern that a recession is going to happen. And that was sort of one of the big predictions that many folks had for this year. And clearly we're going to finish this year with no recession. Economists, once again, have been successful at predicting 10 of the last 5 recessions. And so fortunately, they seem to have been wrong again this year. But we're also going to talk about the dealer's perspective, and they're feeling a little bit more pessimistic this day. We just got the latest results from the Dealer Satisfaction Index. And then I want to take you guys through sort of the big stories of 2023, talk about some of the new trends that are emerging in this post-COVID market, and then talk about some of the inventory and pricing changes that we're seeing out there. But let's start by talking about gasoline prices. This is showing the average price of regular gasoline out there in the U.S. economy going back to the year 2000. And I wanted to point out that gasoline prices went through a massive shock, and I don't think it gets as much attention as it should. But from April of 2020 to June of 2022, we saw gas prices jump over $3.23 a gallon. And that was the biggest increase that we've ever seen. And it certainly sent shockwaves through American consumers. And in terms of for vehicle drivers out there, a $1 increase in gasoline costs adds about another $50 a month to fuel costs for a typical driver out there. And so we saw gasoline in June of 2022 exceed $5 a gallon across the country. And certainly some states always have much higher than that, certainly California. But across the country, we had never seen that level of price increase that quickly to that amount. And I think it really sent shockwaves, as I said, across the economy. And when we look at consumer sentiment, we can see that rising gasoline prices have really had a dramatic impact on how consumers see the U.S. economy. This is data coming from the University of Michigan, goes back to 1978. So we've got 45 years worth of data here. And where we are today is on the far right. And you can see that the sentiment out there in the country is a little bit better than it was in June of 2022, but not much. We still are way below sort of our long-term normal range, that dotted line there. Consumers are still relatively sour on where the economy is right now. But you can see that in June of 2022, when gasoline was hitting $5 a gallon across the country, that was the worst feeling that the American consumers have had in the history of this index. And we can go back to the double dip recession of the early 80s, the S&L crisis of the late 80s, early 90s, the 9/11 terrorist attacks, and of course the Great Recession. Consumers thought the U.S. economy was worse last summer than any of those previous events. And that's going to take some time for the U.S. consumer to recover from that. But we are recovering. As you can see, things are starting to get a little bit better. But the big reason consumers were so pessimistic out there was the concern around inflation. And this is showing the consumer price index going back to 1960. So we've got long data history here. And you can see that in June of 2022, a year and a half ago, we saw the inflation rate reach levels that we hadn't seen in almost 40 years, going back to the early 1980s. And that was creating that massive shock for consumers out there. But the good news is that inflation has been coming down. The Fed started raising interest rates in the spring of last year. And in an attempt to kind of mitigate this inflation, to kind of bring the growth rate of prices down. And it appears that their plan has been working. Inflation has fallen precipitously. We just got a new data point today. 3.1% is where the inflation rate stands. But it's still above the Fed target, which is 2%. So it's going to take a little bit more time to tick down further. But clearly, it does appear like the soft landing, the increase of interest rates to slow inflation, the soft landing may be able to be achieved, that we might be able to address this inflation problem without sending the economy into recession. And that's really been kind of the mood out there, certainly among the equity markets over the last couple of weeks. The Fed is meeting tomorrow, and they're going to be discussing whether they should raise interest rates again. And I think the general consensus is that there's no need to raise interest rates any further. They've been successful so far. And in fact, the general view now is that in 2024, probably starting in the second half of the year, the Fed's going to change interest rate policy and is going to start cutting rates. And in fact, a couple economists out there that I watch from Goldman Sachs and some other places, they're talking about 2 interest rate reductions that they're expecting in the second half of next year. Now, that's a very optimistic view. There are still people out there that say a recession is coming, that the soft landing may not be achieved. But in any event, it does appear that we're not looking at any kind of a massive decline because the economy is still growing at a very strong rate. And when we look at the unemployment rate, it still remains near historic lows. We just got the unemployment rate for November. We're still well below 4%. And you can see I've highlighted here sort of the long-term average of around 6% that we've been running in the 2000s. Clearly, there's no massive job losses that we're seeing there, that the Fed was able to lower the inflation rate by raising interest rates, and they have not caused a massive spike in unemployment out there in the economy. So this is why folks are still saying that, hey, maybe this soft landing is going to be achieved and we're looking at a better 2024. But there's still a lot of folks out there that are concerned that we're still looking at some kind of a slowdown, whether it's a full-blown recession. We don't know yet, but certainly it does appear like there's concern that buying and the overall aggressiveness of the economy and the growth that we've had isn't going to be maintained when we get into the first part of next year. And the big reason being, a lot of folks are concerned about the inversion in the yield curve. And that's what this chart is showing. This is showing the 10-year minus the 2-year treasuries. And normally the 10-year is always higher than the 2-year. If I'm going to be lending money to the government for a long period of time, I'm going to want a higher interest rate than if I'm going to just do it for a short period of time. But when the yield curve inverts, it means that the 2-year is higher than the 10-year, that investors are more concerned about the economy today than they are about where it's going to be 10 years from now. And historically, every time that the yield curve has inverted, the U.S. economy has slipped into a recession a few months later. And that's what those red markings are on this chart. You can see that the yield curve went negative. It was below 0. And then you can see those red lines are showing periods of recession in the U.S. economy. Again, going back about 45 years worth of data. On the far right, you can see that's where we are today. The yield curve has been inverted since July of last year. And so many folks are saying there's just no way to escape this, that we're going to see a slowdown in the U.S. economy. And the reason being is that generally banks can't make money in this type of environment. Banks that borrow short and lend long can't make money when the near-term rates are higher than the long-term rates. And so there's generally a pullback on lending. credit availability dries up, and then economic activity pulls back and we slip into a recession. So that's kind of the scenario folks are worried about. And there is some indication out there that we are starting to see that credit availability is getting a little bit more challenging. This is showing the Federal Reserve's consumer credit data, and it's showing the total amount of auto loan originations that are being made available. And the couple of key points on this, and I've circled it in the red on the far right there, is that the year-over-year change in auto lending has been negative. And so far this year, they're down about 7% year to date. And so the amount of lending that's being made to the auto industry has been getting smaller. And so that's the concern is that that's going to continue and make it much more difficult for folks to get approved for those loans. The silver lining in all of this, though, is that red line, and that is showing subprime share of auto loan originations. And you can see that where we are today on the far right, subprime share, those folks with a 620 FICO score or lower, is only about 15% of the vehicle buying activity right now, far below the levels that we saw during the Great Recession, when nearly 30% of sales were being made to subprime borrowers. You can see that over the last few years, and particularly in the post-COVID market, subprime buyers have fallen out of the new and the used vehicle markets. They just have not been able to buy in the same quantities they did before because they're under more threat in this more difficult economic environment than some of their wealthier counterparts. And so we are starting to see that this credit availability does appear to be getting a little bit more challenging. And there's concern around delinquencies. We are seeing that the yellow line, that is showing delinquencies, folks that are 60 plus days delayed on paying their monthly auto loan bill. You can see that where we are today on the far right, it's spiking. We're looking at all-time highs for the number of accounts that are delinquent. And certainly it's higher than where we were during the Great Recession. But the number of folks that have actually defaulted on that account, they might have been late, but the number of folks that actually just defaulted and completely still remains relatively low. It has not risen nearly as much as the number of delinquencies, as you can see on the far right. So because we have a much better credit quality vehicle buyer today, and that we've lost many of these subprime buyers from the vehicle market, we aren't in the same boat that we were during the Great Recession. And during the Great Recession, we saw defaults really spike along with delinquencies, but we're not seeing that today. That although defaults are rising, they're nowhere near the levels that they were during the Great Recession. And again, that's because the credit quality is relatively good out there. So because of all that, we still see that the recession risk to the vehicle market just isn't that great. And part of the reason being is that we've already lost a lot of the folks that we would lose if we had a recession. Those subprime borrowers, the folks with questionable credit, lower incomes, they fell out of the market in the early post-COVID days. And so if we did have a recession here, it's more like falling off of a curb than falling off of a cliff. And you can see I've highlighted here the new vehicle market during the Great Recession period. The vehicle market was humming along at a 16 to 17 million pace. The recession starts, vehicle sales fell off of a cliff. We bottomed at 10.4 million in 2009 before starting a decades-long recovery. On the right, you can see the vehicle market during this global pandemic period. And clearly we fell off, our run rate of 17 million plus in 2020 when COVID first hit. Then we had the supply crisis in 2021 and 2022. So now we are on the comeback, and we're expecting this year to finish around 15.4 million. And our expectation is even though there's a potential of a slower economy, there is potential of a recession and a slower first half of next year, we still see the vehicle market heading a little bit higher in the next year, that there's still going to be enough demand out there and enough folks that want personal transportation that sales are going to improve a little bit. But as I mentioned, we are starting to see that dealers are feeling a little bit different on the environment out there. We just got the latest numbers from our dealer sentiment index. And one of the big questions we ask is, how would you describe the current market for vehicles in the area where you operate? And you can see that franchise dealers there on the far right, they're at 49. They're below 50. 50 is sort of the threshold of where I'm optimistic or I'm pessimistic on where the market's going. We saw that franchise dealers fell into more pessimistic territory, back to levels that we hadn't seen since prior to COVID. And so, that's one of the concerns out there. The dealers themselves are starting to report that things are looking a little bit more difficult out there, and certainly independent dealers are feeling the same way as well. That they see things getting a little bit more challenging. And one of the main reasons is that we're seeing customer traffic start to dry up a bit. We asked folks, how would you rate the customer traffic to your dealership over the past 3 months? And again, you can see that yellow circle there on the far right. Franchise dealers rated this a 40. We hadn't seen that level since the COVID days themselves. And so clearly this buying environment out there appears to be changing a bit. There's not getting as much traffic as we would normally get, certainly at the end of the year here. And so that's another one of those signals that we're concerned that the market is slowing a bit out there. The other one we ask dealers about is inventory and profits. And we asked, how would you describe the current profits over the last 3 months? And you can see that's in green, and it's been falling. We had those great days of 2021 and 2022 when profits were looking very, very strong. Well, those were the old days. We're back to the really old days, sort of the pre-COVID levels now. We're back to profits being where they were prior this whole thing starting to happen in 2020. And we also asked folks, what about your inventory levels? How would you describe your current inventory levels? And you can see that those were in a very tough time back in 2021, but they've risen substantially since then. And in essence, we're back to where we were prior to COVID. Both profitability and available inventory have kind of moved back to where we were just a few years ago. And we asked folks, what's holding back your business out there? And what dealers said is that the number one issue out there is interest rates, followed closely by the economy and market conditions. They're all kind of very, very similar. As I said, all of those things are facing a challenging time right now with affordability and the high interest rates and certainly the high vehicle prices themselves. But as I said, there is this thought that next year, in the second half of the year, we are going to start to see the interest rate cuts happen. So that should mitigate some of this, that the interest rates hopefully this time next year are going to be substantially different than where they are today. And that'll help boost some activity. The other one that folks were saying that they're concerned about is the political climate. And it's a very kind of vague measure. It doesn't really describe what the political climate is, but certainly with the election coming up and all of the turmoil that we've seen with Ukraine and the Israeli-Palestinian war, there's a lot of uncertainty out there that folks, I think in general, are just concerned about. And all of these factors are going to be weighing on sales activity here as we start the year next year. All right, so let's talk about 2023 and how the market is finishing up. This is looking at the monthly light vehicle sales SAR, and you can see that we had the November data point of 15.3 million, up substantially from where we were sort of in the worst post-COVID selling rate back in September of 2021. We've had a fairly consistent improvement in the vehicle market over the last few years. But you can see that the pace appears to be slowing just a little bit over the last few months. And that's what we're seeing, that there does appear to be a little bit of less activity as we're heading into January. And so there is this concern that the slowdown that the dealers were just telling us about, we are starting to see that in the actual numbers themselves. But behind the scenes, I wanted to kind of take you through some of the bigger trends that we're seeing out there in the market. And there's lots, but I've just kind of highlighted a couple I thought you folks would be interested in. And on the left here, one of the big changes that we're seeing here in the post-COVID market is that the American brands have lost a tremendous amount of market share. Back before COVID, American brands and Asian brands were competing neck and neck at around 45% market share. But you can see the Asian brands had some volatility. They gained some market share in 2021 and gave it back last year They're essentially a little bit better this year, but the American brands have been falling in the post-COVID market. And really, if I took this trend out longer, you would see the American brands have been losing share for over a decade now. Much of this can be attributed to their product selection. They pulled out a lot of the small car product segments. And so they've been losing market share from that because there hasn't been a lot of growth in the segments that they're heavily involved in, like pickup trucks. The other big groupings out there are European brands who appear to be essentially flat during this whole tumultuous last couple of years we've had. And of course, the EV directs, which is essentially Tesla at this point, although there's a couple more these days. But they've been gaining market share substantially, and they're now at about 5% of the market. So it's hard to say that the EV directs are directly taking share from the American brands, but in terms of domestic U.S. production, it does appear that Tesla is the one that is grabbing that market share from the Detroit 3. The other trend that we're looking at is on the right, and that is looking at the luxury market. And in dark blue there, I've got the luxury brands without Tesla. And one of the key takeaways here is you can see that luxury share is rising. It was about 12% of the market in 2018. It's now approaching 14% of the market. So the luxury brands without Tesla appear to be gaining in popularity out there in the market, which is not surprising because, as I said, we know we have a more affluent buyer in the market today. And we know that these high prices is leaving a lot of folks out of the market, and certainly luxury, not being able to afford these luxury brands. So who's left in the market are people who can afford these luxury brands, and that's what they appear to be selecting. But when you throw in Tesla with the luxury, you can see that this luxury share is really rising to almost 18% of the market. And so it's really the vehicle market has been changing quickly to become a much more affluent product. Certainly the new vehicle market is not an everyday American's product anymore. So let's talk about the big market share changes that we've seen so far this year. And on the left, I'm looking at the large brand market share changes. And what we can see is that Honda, Nissan, Tesla, they've all had a very, very strong year. Honda and Nissan both are seeing strong gains in market share, in large part because they were so lean last year and they lost a tremendous amount of sales because they did not have inventory. Well, that inventory is back. And so they've been able to regain much of the share that they lost last year. And they're taking it from, their arch rival, Toyota. We can see that Toyota's share is down substantially this year. I would say that this is not a rejection of Toyota's products, but rather limitations on their availability. The first half of this year, Toyota was still in a very, very tight inventory environment, but that's changed here in the second half of the year. So their situation is improving quickly, but clearly it's had lasting impact on hitting Toyota's market share for this year. The other folks that are challenged this year, certainly Ram, Ford, and Jeep, they've lost a tremendous amount of market share. That's not because of limited product. That's because of high price points and their customer base probably being hit pretty hard by these high interest rates. And when we look on the right, we can see the smaller brand market share. Buick and Acura, two very, very different products, are both having a very big year. Acura is up because, just like with Honda, their inventory has improved dramatically from last year. And Buick, the inventory is up, but it's really that the small SUVs, and Buick in particular has been very popular. The small SUVs have been selling like hotcakes for some of the Detroit 3 brands. Certainly for Chevrolet and Buick being one of their brands, General Motors and Buick being one of their brands, the small SUV has really been driving their sales success this year. At the other end, though, you can see BMW, Mercedes, they're losing market share. And one would have to think that Tesla is probably one of the big competitors there that is taking some of that market share from them. And when we look at the sales year to date, what the change has been on a year-over-year basis, many of these same brands jump out as having the biggest sales successes this year. Honda, Acura, Buick, they're the leaders so far this year and seeing gains. And on the far left, we can see the Jeep, Lincoln, Ram, these American brands are looking at relatively weak sales here through the year, so far through this year. Overall, nationally, we're up about 12%. But you can see that there's a number of brands that are doing substantially better than that. And there's a number of big brands, like Toyota, like Volkswagen, like Ford, that are far below that national 12% gain level. The other big trend we're seeing out there is that fleet sales have really been driving sales during this sales recovery period. And we look sort of in 2021 in the immediate days after COVID, the share of the market that's for retail customers, folks coming in off the street and buying a vehicle, has fallen 7%. And that now that we can see that fleet share of the market, commercial sales to the rental car companies and commercial activities, they're almost 20% of the market now. So that's really what's been driving the activity. And we look at sales year to date, rental sales for the rental car companies are up 59%. Commercial sales are up 35%. Purchasing, folks who actually go out and take a loan or pay cash for the vehicles, only up 7%. And leasing is only up 12%. So the retail side of the business has not been the big driver of this year's success. It really has been a fleet. But we are seeing gains on the retail side as well, just not quite as strong. But one of the things I thought was kind of interesting, and this is a little bit of a complicated chart, so you may want to come take a look at this later, come back to it. But this is looking at OEM channel balance. And knowing that we have these different channels of leasing vehicles, purchasing of vehicles, and then rental cars and commercial vehicles, the manufacturers are all selling into these different sales channels. And in theory, they would have perfect balance if they got the same amount of market share from each of these channels. So for General Motors, you can see that they're approximately 16% of the overall market. That's what that dark blue bar is for General Motors. But they're only, when you look at just the retail leasing in the market, they're only about 14% of all of the retail leasing. They're about the same 15% of all the retail purchasing. When you look at rental fleet sales, though, they're about 20% of all rental fleet activity, and they're about 22% of all commercial fleet activity. And then in terms of sales times the average transaction price, they're about a little bit overperforming on their share of the overall revenue for the industry, and they're a little bit more than their share of the overall incentive spending for the industry. And you can see when you look across, this gives you an idea of how the different manufacturers are coming to market this year. And you can see, for example, Toyota, they're overperforming in purchasing and are not as focused on leasing, versus Ford is tremendously over-reliant on commercial fleet. Almost 30% of their of commercial fleet activity is from Ford. And so you can really kind of see that the different manufacturers are taking different approaches to market. Some focus much more heavily on leasing, some focus on purchasing, some are focusing on the commercial side of the business. And so those brands that had a particularly good year this year, like a General Motors, part of that success really has to be to the fact that they're focused on the commercial side of the business, the rental and commercial fleet, and those are up big, and that's what's really been lifting their sales. So the other big trend that we're seeing out there, of course, is the alternative fuels. And just as I showed you, gas prices started taking off in April of 2020, well, so did alternative fuel share. They started taking off at right about the same time. In orange there, you can see that's hybrid only share of the market. And back in 2019, it was about 2.8% of all of the vehicles sold. Now, so far this year, it's almost 9% of all vehicles sold are hybrids. And then the green, you can see that's EV share. And that was only 1.3% of the market back in 2019. And now it's over 7% of the market. So combined, these alternatives are approaching almost 16% of the overall market, and it's only heading north from there. And so it's going to be very important for manufacturers to have a wide product portfolio in order to participate in these alternative fuels for customers that are looking for that. One of the things that we're expecting to have happen in 2024 is that we're going to see a surge in leasing, particularly for EV vehicles. And much of this is due to the IRA, the Inflation Reduction Act, which allows for that $7,500 rebate to be applied to a lease, and regardless of income constraints. And so we're talking about substantial savings on a lease. And just to give you a ballpark idea, for a $50,000 vehicle on a 36-month lease, that $7,500 capital cost reduction is going to knock over $200 off that monthly payment of that EV lease. And so that's why we think that's really going to be an important mechanism towards EV adoption, is getting more and more folks to try EVs with this leasing. And we're already seeing that in the numbers today. This is looking at registrations data, and I looked at what is leasing share of retail sales, and I split it out by EVs only versus gasoline vehicles only. And the dotted line is the gasoline vehicles, and you can see that it's essentially it hasn't really made any big improvements over the last couple of years. It's up a little bit from the bottom we hit back in 2022. But no great shakes out there. It's not like leasing is really taking off. But when you look at EV leasing, you can see the IRA passed and EV leasing is really starting to take off. And it's now approaching 30% of all EV sales as being a lease. It may even go higher from there. And so that's one of the other trends that we're seeing out there. And as I mentioned before, not all the different manufacturers are prepared to take advantage of this surge in the alternative products out there. This is showing all the different manufacturers and what the fuel share is of their total sales. So you can see on the far left there, you have Lucid, Tesla, Rivian. These are 100% EV companies, so they're all green. All of their sales are from EV. But then when you start looking beyond them, you've got Geely, Volvo, and Daimler, and VW. They have about a 10%, maybe a 20% portion of their sales that are coming from electric vehicles, and some of that orange. They're also getting just a little bit of hybrid vehicles. But you can see there's some manufacturers out there that only have red. They only have products that are gasoline vehicles. Subaru just started selling their EVs, so they've got a little bit of green, but for the most part, it's still fully red. Certainly Tata and JLR. Mazda, you can see they don't have a very wide product portfolio. Even General Motors just has a little bit of electrics, but they don't have any EVs, as well as Nissan. So there's a number of brands out there that there's all this talk about folks wanting more hybrids. Not all the different manufacturers out there are going to have products for them, but that is going to be changing. We're expecting well over 100 different EVs coming to market here over the next 3 or 4 years. So there's going to be a wide product offering that's going to change this chart dramatically here. So we'll keep an eye on this one because it is going to be quite volatile here over the next year. So let's just give you a quick update on the other trends we're seeing out there, and that's inventory. And this comes from our vAuto data. You've seen this chart many times, but on the left, this is looking at available supply. And you can see the yellow line is where we are today, and we're essentially approaching where we were back in 2020 in the early post-COVID days. Today, where we look at supply compared to where we were a year ago, we're up 56%. There's almost 900,000 more vehicles on dealer lots across the country than they were this same time a year ago. So this supply situation has dramatically improved. And the days of supply, though, is starting to creep even higher. You can see that on the right there. The days of supply is now up about 39% from where we were last year. And in our measure, it's hovering around 70 days of supply. And so, we're almost back to kind of pre-COVID levels, still a little bit below that gray line of where we were back in 2019. But, certainly for those of us who were thinking, oh, maybe the industry is going to change, we're going to be lean and mean from now forward. We're not going to overproduce. We're going to, not have to rely on incentives to sell these vehicles. We'll throw that all out the window because we're right back to where we were before. The industry is producing, probably overproducing at this point. Inventory is accumulating. And so we really, as an industry, haven't learned anything, or maybe we're just kind of stuck because the factories have to sell a certain amount to be profitable, so they have to build these things. But clearly the inventory situation has changed dramatically. But when we look under the hood and look at the different brands, we can see that they're in a very, very different situation across the country here. We can see Toyota, Honda, Kia, they are still looking at inventory situation that's relatively tight. Now we know that their inventory levels are building, but on compared to some of their competitors out there, they're still remain in a very, very tight inventory situation. On the far right, though, you can see many of the Detroit 3 brands, Ram, Lincoln, Chrysler, Jeep, they're really starting to see their inventory accumulate dramatically, well over 120, 130 days of supply. And so we're already starting to see that incentives are changing dramatically in order to reflect the situation that some of these brands are in, that there's just too much inventory and the pricing has to adjust in order to reflect that. And that's what we're seeing. Prices are starting to come down because the inventory situation has improved so much, and the days of supply is accumulating because sales have not quite kept pace. We're seeing that transaction prices are now coming down. And in fact, we've had transaction prices down negative on a year-over-year basis for 3 months in a row. And we've never had that in our data set that we can go back to early 2012. Just never have had transaction prices be negative for 3 months in a row. Just hadn't happened. But you can see from where we are today that it does appear that the big run up that we had from 2021 when the supply shortage began, prices ran up. We saw still growth last year, but in 2023, prices have started to come down, certainly in the second half of this year. And much of this can be attributed to Tesla changing their pricing and being much more aggressive on their EV price. But most of it is really due to the increase in incentives. And in fact, we can see out there that the pricing situation has changed dramatically in the marketplace. This chart in green, I'm showing the price strength, or what is the transaction price relative to the MSRP. And you can see that green line in the early days prior to COVID, about 94% was the average transaction price relative to the MSRP. After we had the supply shortage, you can see that it really spiked towards 102% was the transaction price relative to the MSRP. And now it's fallen back down and stands at about 98%. Not quite to where we were prior COVID, but certainly headed that direction. And then the blue line is showing the incentive that is offered as a percent of the transaction price. And you can see that prior to COVID, this normally ran sort of in the 10 to 11% range. Once we had the tight inventory environment, this fell dramatically and bottomed out substantially to just about 2% was the incentive relative to the transaction price. But now it too is rising dramatically and is approaching 5-6%. So the strong margins that we had out there are now weakening, and incentives are having to rise because the inventory situation has changed so dramatically. But when we look at the different brands out there, we can see there is some commonality, which is all brands are increasing their incentives. Even though Toyota and Honda, who we saw on a previous slide, are still relatively tight on their inventory, they too have increased their incentives relative to where they were last year. So I'm showing in green here, this is incentive as a percent of the transaction price in November of last year. And then in light blue is what it is in November of this year. And then the dark blue line is showing that difference. And I've sorted this by who had the biggest difference and who's had the smallest difference on a year-over-year basis. And the key takeaway here is Tesla. Tesla has seen a monster increase in their incentive as a percent of the transaction price. It's been about a 9 percentage point, about a 6 percentage point increase. So it's up dramatically. Ram, Hyundai, BMW, Jeep, they all have also seen substantial increases in their incentives relative to last year. And then on the far right, you can see Chevrolet, Honda, and Toyota. Their supply situation still remains relatively lean. Their sales have been relatively good, although Toyota was challenged earlier, but it's gotten a lot better. And we can see that because of their situation of having a little bit of tighter inventory, they can also be a little bit tighter on the discounting. And so we're going to see market share changing dramatically as the Detroit 3 and Hyundai and some of these brands that are seeing inventories accumulate, they're going to get more aggressive on their pricing. And the question is going to be, is it going to force Chevrolet, Honda, Toyota to follow suit and get more aggressive on their own pricing, or else they'd be giving up market share. Let's talk for a bit about the used vehicle market. This is coming from our vAuto data, and the key takeaway here is the used market is holding up. We haven't seen any massive decline in used vehicle sales. It's essentially on par from where we were last year, maybe down just a little bit. And our expectation is we're going to kind of hum along at this level going forward in this next year. No big surge in used vehicle sales, no dramatic change, just kind of a humming along here, as I said, relative to where we were last year. Things just being a little bit better, though, in the next year. And the key reason being is that we're seeing prices come down. This is from our vAuto data showing the average list price in the used vehicle market. And you can see that yellow line, it's been down this whole year from where we were last year, down about 4%, give or take, overall in the year. But we haven't seen any collapse in prices. Prices have held up relatively well, given all of the headwinds that we've been facing this year. And really the main driver of that is that we know that the future supply in the used market is going to be challenged because there's just not a lot of off-lease vehicles that are coming. And that's what we can see here, looking at lease maturities. This is showing our estimate as to vehicles that were leased 3 years ago and are now going to have their leases expiring. Our expectation is that over the next couple years, we're going to have substantially fewer lease maturities, in part because of the low leasing share that we've had over the last couple of years, in addition to the low volumes that we've had over the couple of years. And so it's sort of a double whammy that when we look forward into the 24 and 25, we know that the number of maturities that are going to be coming to market are going to be substantially fewer. And that's those gently used, off-lease vehicles, the CPOs. Those are the vehicles that people really love, and they're going to be in very, very tight supply. And we know that that the brands themselves and different sales organizations have been creating new CPO vehicles from older model years. I think we're up to 6 years and 60,000 miles. I think there's some that are extending to create a CPO vehicle, and they're doing that because there's just not enough 0 to 3 model year vehicles that are going to be available. And so the fact that we know that future supply is going to be so constrained is contributing to vehicle prices maintaining that relative stability that they've had. When we look at what's happening at Manheim, prices have definitely been coming down at Manheim as well. But we haven't given back the full gains that we've had in this post-COVID market. This chart is showing the year-over-year change in the Manheim index, our average auction prices at the end of the year in December. And you can see that in 2019, auction prices were up about 2.5%. In the COVID year of 20, they finished up about 14%. And then when we got to the lean inventory, auction prices were up almost 47%. But then last year, we gave back about 15%. And our expectation is that when the dust settles this year, we're going to finish the year with year-over-year prices down about 5.6%. But our expectation is that next year, they're going to return to the positive and that we're going to see vehicle prices start to rise again. And so, again, and that's going to be due to the fact that we're expecting these a little bit stronger demand as well as this lean inventory environment we know that's going to persist. So just to summarize, these are the forecasts that we expect for 2023, where everything is going to finish. I guess the big one, though, is for what we're expecting this next year. And so the key takeaways are we're expecting new vehicle sales to improve just a little bit. Retail sales are essentially going to be flat on a year-over-year basis. But again, with this potential recession coming, I think that's pretty welcome news that we're not expecting any kind of a serious decline in the vehicle market. Leasing volume is going to rise dramatically. We think there's going to be a lot more leasing. Lease penetration is going to rise. We expect more CPO sales. And as I mentioned before, we're expecting the Manheim index to finish the year positive on a year-over-year basis, which is going to, again, make future vehicle sales maybe a little bit more challenging because they're not going to be as discounted as they are today. There are some concerns, though, that we have out there. There are risks to this outlook that the Fed may raise interest rates again and kind of make a policy mistake and that could lead us into a recession. We'll find out more tomorrow. They're going to announce their latest policy at 2 o'clock tomorrow. As I said, most folks expect them to be done with raising rates, but they may be looking at different numbers and decide to keep going. As I mentioned before, the banking system, because of this tightness in credit, we could see credit availability dry up across the economy. That could make things a little bit more difficult. And then, of course, the geopolitical environment we're dealing with all the craziness in the world, certainly that could have, if any of those issues explode or get much more serious than they are today, that could certainly be something that could derail us on our recovery. And of course, the labor market itself. We are seeing that real wages are rising there out in the economy. If they continue, that could become inflationary again, and that may force the Fed to have to do some sort of additional policies if we see wages continue to rise, because that would be very detrimental to this fight on inflation. And of course, there are some upside risks. We could see a stronger population and labor force growth and more immigration. All of this would bring more consumers to market. We could see stronger income gains from strong consumer spending. There's a lot of feeling out there that consumers are still financially in pretty good shape, although we are seeing that credit card debt has gotten quite high. But and of course, the biggest one I think that could be an upside risk is productivity gains from all of the technology investments that companies have made over the last few years, particularly in AI. It's just started to be implemented, and we're going to start seeing, I think, some real cost savings from AI here in 2024, and all of that may lead to even greater gains for the economy and the vehicle market as a whole. So those are my comments. I think we should all be pleased that we had as good a year as we had in 2023. I think most of us started the year being a little bit more pessimistic than it actually finished, and we're going to hang on to those gains that we've seen, I think, in 2024, but cautiously optimistic. I think that's really kind of the approach to take here as we look into next year. So those are my comments, and I'd be happy to address any questions you may have. If you want to send them my way, I'd be happy to get back to you.
Charlie, thanks so much for joining us today. We really look forward to your quarterly reports and appreciate you keeping us updated throughout the year with this invaluable information. Again, you will all be receiving a copy of this webinar by the end of this week. To those on the line, join us back here for our final webinar of 2023, next Tuesday, December 19th at 2 p.m. Eastern, as Strategic Source shares the 20 best ideas to reduce costs in 2024. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.